All right, so what do we do if we have deflation? How do you invest in a deflationary economy? That's tricky, isn't it? What do we do? Haven't had to deal with that in America literally since the 1930s. So I think we have to start and say, how do we invest in an inflationary economy? Well, that you certainly want to stay away from fixed income. You don't want to be the lender, you want to be the debtor, if that makes sense. All right, so by you buying bonds, so let's think about this. I mean, this is literally as simple, and when you think about it, how you want to invest in an inflationary economy, why you don't want bonds, for instance. All right, and then on top of that, why you do want to own debt. And what I mean by own debt is being in debt. That's literally what I mean. You owe money, not own it, you owe it. In an inflationary economy, the price of goods is increasing each and every year. But you have a fixed income, all right? And on top of that, your asset is fixed as well. So it costs $1 today, it's gonna cost $1.03 tomorrow. I'm getting $1 in income today, I'm getting $1 in income tomorrow. I'm getting $1 income next year, and the year after, and the year after. But the price of goods, what cost me $1 today, cost me $1.03 tomorrow, cost me $1.06 the next day, $1.10 when you factor in compounding. And yet I have a fixed income, which is being trounced each and every day by an inflationary economy, right? So again, if I have it fixed and the price of the purchasing power is going up, inherently I am losing each and every year. On top of that, I still got to pay taxes on that dollar of income because it's literally income. And so because I have to pay tax on that, I lose more purchasing power. Now, I think a lot of people overlook the fact that, well, the tax bracket is inflation adjusted too. So what's going on here is you'll pay less and less tax on that dollar of income from your bond, from your fixed income, simply because the tax brackets are increasing by 3% a year or whatever the inflation rate is, and you have a fixed income. So the tax bracket, the tax argument becomes less and less as inflation increases, simply because the tax brackets are adjusted for inflation, thankfully. So taxes really aren't the bogeyman of investing in a fixed income, an inflationary economy, because that will be less and less and less. I hope that makes sense. But what is a bogeyman is the fact I have a fixed income, and the cost of goods for which that fixed income can buy is growing each and every year, and I'm not keeping up with it. So we know we don't want to own debt. We don't want to be the lender, because what I just said. Now, the corollary to that is you want to be the debtor, if that makes sense. And this is going to sound weird, but you think about it, same thing. You loan me $100,000, I pay $1,000 a year in income. So it takes me $1,000 to pay you your income for the $100,000 you loan me. I can turn around and buy something with that $1,000 that costs $1,000 in year one. The next year, I pay you $1,000, but the purchasing power is going to be $1,030. So you as loaning the money to me is losing money, whereas me, I'm not, because I have to pay you that fixed income, and at the end of the maturity date, however long, 5, 10, 15, 30 years, I still have to stroke you a check for $100,000, which won't be worth the $100,000 in purchasing power. So as the borrower, inflation is actually reducing my debt relative to purchasing power each and every year. I hope that makes sense, but that's an inflationary economy. You want to borrow money. Now, I'm not saying go borrow. I'm not saying that, but just this, I want to get a premise for a deflation kicks in. You don't want to own debt. You want to be the ower, not the owner in that regard. Again, if you owe, it is being evaporated by your very eyes, but nothing more than inflation. I mean, think about it like this. It's that simple. We'll just say you live in Argentina. You borrow $500,000 to buy your house, right? You'll say the bank, I'll pay you $500,000 in 15 years, and I'll pay you, I don't know, freaking $10,000 a year in interest. The very next year, it doesn't take $500,000 to buy your house. It takes $600,000 because of a 20% inflation. Well, you still only owe $500,000. So whereas before, for simplicity, you were making $500,000 in income. Now you're making $600,000 of income, but you only have a $500,000 debt. The next year, it takes $700,000 to buy what $500,000 used to be. So now my house is worth $700,000 simply due to inflation, and yet I only owe $500,000. My job, which was paying me $500,000 2 years ago, is now paying me $700,000, which means every year the value of the real purchasing power value of that debt you have loaned to me it was reduced. I hope that makes sense. It's critically important to understand how debt is bad in an inflationary economy. Now, are stocks good or bad? Well, stocks are better just because they are inherently inflation adjusted by the earnings growth of the corporations for which you invest your money in. I mean, that's what it comes down to investing. You're investing for earnings growth year over year and dividends. That's it. Earnings growth are going to be inherently adjusted for inflation. I mean, the earnings growth are going to adjust with inflation because they can sell products at a higher cost than what they did before, not because quality has improved, but just because of inflation. You know, when I was a kid, you could buy a can of Coke for 25 cents. Now you can buy the same can of Coke for $1. All right, so now let's just say Coke, they have nothing else but that one can of Coke. It costs them, half the cost of goods sold. The cost of goods sold would be 12 cents back when I was a kid and 50 cents now. And so they'll just say their net profit is 50%, all right, of the sale. All right, which cost of goods sold is 12.5 cents in 1975. Cost of goods sold is 50 cents in 2019. So 12.5 cents is their profit, and we'll say they have a payout ratio of 50% of their profits. So they're going to be paying out $6.25 as a dividend. That's a payout ratio of 50% of their profits. All right, well now they have 50% profit on a dollar sale. All right, so they have 50 cents as profit. They pay out 50% of that profit. So now they're paying 25 cents as a dividend. Same exact can of Coke. Nothing has changed other than inflation. So where I was getting 6.25 cents as a dividend, now I'm getting 25 cents. I haven't bought anything different. I can't use that money to buy more stuff now. It's just the dollar has devalued. Was that by 400% or something like that? And so because of that, I'm getting a dividend of 25 cents. However, that doesn't buy me any more than the dividend of 6.25 I used to get before. Hope that makes sense. A lot of people don't get this, and that's a mistake. Stocks inherently are inflation hedges because of the dividends and earnings growth year over year that will theoretically keep up with inflation. Now, every stock is based on the underlying company that issues it. So in theory, that would make sense that the stocks can keep up with inflation. But in reality, some stocks go kaput regardless of the economic cycle that we're in. They lose their market share. The CEO becomes a drug addict. I mean, so many different reasons why a company could go kaput. But stocks are definitely a hedge against inflation in the theoretical sense, which I actually subscribe to. A basket of stocks of the S&P 500 that will remove a lot of the individual stock risk. So a CEO that becomes a heroin addict, he won't take you down. He'll take one sliver of your overall stock portfolio down, but not the entirety if that's all you got in that one company. All right, so we know you don't want to be a lender. You want to be a borrower if you need to be. My preference is still not, because you still got to come up with cash flow. And if you get laid off, where's that cash flow going to come? Point two, you want to own stocks. in an inflationary economy. Point 3 is real estate adjusts with inflation. I mean, are there areas that you can make a killing? Sure, if you can time it right. I told you before, what I've learned from my dad about this is go where the gays are, man. The gays got the guts to go to dilapidated towns, fix them up, and then when they make them safe, the hipster whites feel safe enough to move in, and next thing you know, those are hipstervilles, and the poor folks are being priced out of the market for these rich kids to come in and buy up all the stuff. So you can make a mint on real estate if you just know where to go, and I mean, that's just a crapshoot. You don't know. What you had thought would be a place for hipsters to move into may not come to fruition. You just don't know. Residential real estate, well, I mean, you look at the prices going up based on interest rates being down, that's one thing. You also got to look at, residential real estate. If we got a growth limits like in Portland, Oregon, they have smart growth and they can't build. And so now if you want just a 3-bed, 2-bath house, you got to build way the hell out of the city. Not that you'd want to live in Portland, Oregon anyway, but if you did, you're not going to buy a house for affordability for a regular middle-class family in Portland because they put all these stringents on growth. California, they're putting PV panels, mandating all new homes that have solar, photovoltaic. All that stuff is going to increase the price, increase the cost of housing. But that's political driven. I've read the article from this guy, I forgot who it was, these professors, I think from the Cleveland Fed or something like that. And they look at historically the prices of real estate throughout, like from 1850 today in all these different countries. And by and large, they all follow inflation. So we can say real estate is a hedge to some degree against inflation. And I agree with that without question. I don't have a qualm with that. I don't think you should assume you're going to get any more. I don't think you should assume you're going to get any less unless there's an exterior reason that you think that, i.e. the gangs are moving in, the schools are falling apart, or the hipsters are moving in, and so now it's safe for the wealthy white people to move in, and they're hipsters. That if there's an extenuating circumstance, by all means, use that in your prognostication. So that's inflation. Bonds, nope. Stocks, yep. Real estate, sure. All right, so now let's turn that around, 180 degrees, deflation. Well, if stocks are a hedge against inflation, what happens with deflation? And this is what we saw in the 30s. And think about it from a cash flow perspective. If I now was buying that can of Coke for $1, but I can only sell it now for 75 cents, the cost of goods sold I'd have dropped to 37.5. Before we had a cost of goods sold of 50%. Well, what's the biggest source of expenditure for a business? Is labor cost. All right, so if my cost of goods sold before was 50%, i.e. is 50 cents to produce one can of Coke, and now all the prices, and to keep up with my competitors who are dropping their prices, to keep up with the new entrants to the market who are cutthroating me, to keep up with just the goods are costing less, which is good. And the sugar, we'll just say the sugar cane, the cost of shipping, all that. To keep up with all that, I'm going to reduce my prices. And initially, I think that's a good thing. How is it going to go to my employees and say, hey, everybody got to take a pay cut? The cost of goods sold, we got to keep at 50%. Think about that for a second. I have to drop my price. Now, I don't have to drop my prices from $1 to 75 cents. I don't have to. I could keep it at $1. But if my competitors are pricing undercutting me at 75 cents, now I am, in that case, I'm 33% higher than my competitors. If I was even Steven with my competitors before, and now I'm just, by the power of deflation, 33% higher from a cost perspective, yeah, it's going to be hard to, competitors aren't going to say all of a sudden I'm 33% higher in quality for a product. So my competitors are going to say, wait a second, man. I could buy, in economics, we call this a substitution effect. Coke's charging $1, Pepsi charging 75 cents. Before they both charged $1, Now Pepsi is down to 75 cents, but Coke's up to $1. Why would I buy Coke for $1? It's not that much better than Pepsi. So the substitution effect would say, I'm going to spend 75 cents as opposed to $1. So Coke would have to reduce their prices to keep up with their competitors. Basic economics here. All right, but now how do you go back and tell the biggest cost of the cost of goods sold, which is your labor? How do you go back to them and say, hey folks, guess what? We got to maintain cost of goods sold at 50%. What are your employees going to do? Think they're just going to take that sitting down? No, they're not. So that's where the thing comes in, is that you're going to have to reduce your prices, but you're not going to be able to cut your margins as quickly as your prices are being reduced. And you could say, well, Josh, Pepsi has to deal with the same thing. Yeah, absolutely. All competitors are going to have to deal with this, which opens an opportunity for a new firm to come to the market, potentially. But the new firm will have to find employees, because they still got the labor cost, who are willing to work less than what Pepsi and Coke are doing. Either way, margins are going to be reduced. There's no getting around that in a deflationary economy, because employment is the biggest expense. And don't tell me, we just asked your employees to be part of it. The employees said, man, I got a mortgage. I bought my mortgage on the assumption I'm making $50,000 a year. Now you want me to take a pay cut to $40,000 a year. I can't afford that. The employee can't then go to the bank and say, hey bank, Coke dropped their price of a can of Coke from $1 to 75 cents. And in order to keep their cost of goods sold at 50%, I'm taking a pay cut of 30%. Can you do the same on my mortgage? The bank's like, no. You see how this can work? Not good. So what will Coke do? Well, they're not going to have pay cuts, at least for a good while. Pay cuts. Because that just creates chaos on the work front. They don't want that. They're going to find the cheapest possible goods that can go into the product, the sugar cane and whatever else they can get. They'll be scouring the market for the cheapest possible stuff. And then they're going to cut back the dividend. I mean, inherently, if they're paying out 50% as a dividend on the 50% profit margin, that will be the first thing to be reduced. And so while we sit there and say stocks are a hedge against inflation, they aren't necessarily a hedge against deflation. In fact, in anything, it could be the exact opposite. Simply because the dividend gets reduced, the earnings growth year over year is reduced as well, simply because of the fact they have to drop the price to stay competitive, and on top of that, their labor costs don't drop correspondingly. And that's a trying thing, man. That's a trying thing, because they start trying to get it out of the employees. That ain't gonna happen, man. So the only way to do it is to get out the dividend. And so now you, as an investor who are relying on dividends of 3% a year or a payout ratio of 5% a year, your dividend has been halved, which inherently makes the value of the stock lessened right there, because you're saying, I'm not getting as much on a dividend. Part two is you're sitting there saying, could that happen next year too, right? Because you're saying, well, they dropped it this year. What's to say they're not going to do the same next? Ooh, trouble. Not quite on the Western Front there, my friends. And part three, you got to think too, well, the earnings growth isn't going up because they're going the exact opposite. We have deflation, and so inherently the earnings are going down. So you got dividends going down, cost of goods sold, going down theoretically, but not nearly to the extent the price is dropping. And on top of that, we have earnings growth year over year declining relative to what it was the previous years. That's a big problem. So stocks aren't inherently a good hedge against deflation. They're not. And then we just look at Japan, like I said, the Nikkei, you got hammered, came back up around. Again, I don't know if that came back up around because the PE ratios were so low, there's no other place to park your money. You don't want to park in a negative interest rate bond, so we're going to inflate other assets just by the government dictate. But we're not having inflation there, we're not having growth. So at some point, that's the PE ratios in Japan stocks. Now, I literally don't know what it is. I just know they're up 300% from 2007. But at some point, if that continues on that trajectory, the PE ratios are going to be nosebleed seats, and they'll come back down again. So what do you want to be in a deflationary economy? Is stocks, all right? Real estate, sure, because real estate, while it mimicked inflation on the upside, so to speak, it is a fixed asset. That's a fact. A home, it can lose value, and we've seen that time and again. One of the reasons they got crushed so much, though, is because of leverage. People just didn't have the money to pay off the mortgages for the loans they owed. So you can't sit there and say 2005, 6, and 7 were an example of a real estate crisis during deflationary times. That was just from leverage. And anytime you get huge leverage in any kind of product, it always ends the same with people losing their shirts. That's a fact. It's a greater fool theory. Who can I sell this? Who end up holding the wet bag when the markets tank? Now, but you still need a place to live. So real estate is always a good thing to own, just because you always need a place to live. That's for sure. But what's the best thing in a deflationary is not to be a borrower, because just like the opposite of inflation, which is essentially wiping out your debt in front of your very eyes, deflation, it's increasing your debt. Because now you bought a $500,000 house and you borrowed a $500,000 mortgage on it. Well, now you still owe $500,000, but the average house now is $400,000 because of deflation. I'm just using that for example. You still owe that $500,000. You are fixed. It's fixed. All right. So your loan is fixed. So any fixed income loan you have. Sorry, I'm getting all dark here. I don't know how to put it on the. I don't know how to put on the light here. But anyway, any fixed income that you have, or fixed debt you have, is a wrong answer, because you're going to owe more and more as deflationary times come. So you don't want to be a borrower in a deflationary economy. You actually want to be a lender. The most valuable asset you can have in a deflationary economy is cash, without question. Maybe even long bonds. I would be hesitant to buy long bonds, because we haven't seen, I guess you could say 1982, that's inherently inflationary, but long bonds paid off well. In Japan, I imagine their long bonds from early to mid 1990s till today have an incredible investment. I don't know, but I'd be hesitant to go long bonds, just because how long does deflation truly last? I don't know the answer to that. But we don't have too many examples of long bonds in an inflationary economy. We just don't. It's the exact opposite. Long bonds in an inflationary economy, and there you got skunked. So what you'd want is you want cash and CDs. You want a fixed asset. It doesn't have to be too short terms, but certainly, say 1, 3, and 5 year laddered CDs, fixed annuities, anything that's fixed is what you want. I still say on the shorter end of the yield curve, because you don't want to be locking yourself down in a unique environment where everything is just upside down. We've been so trained to look at inflation that to look at anything else, what would you do? I don't know. So what does this mean? Well, this goes back to my whole thing on the barbell approach, man. I think you got to hedge both ways. If you're going to retirement, I think you got to say, I need to be careful for deflation, and I need to be careful for inflation. And that's where, a fund like the Wellington Fund or the Wellington Fund or just my old barbell strategy. Maybe ramp up your cash holdings a little bit relative to, I was saying like 80-20, maybe do 70-30, 65-35. At the end of the day, I'm still bullish on stocks, so I'm always going to default more to stocks and bonds for sure. Just because the Fed has it, and look, we should all recognize the Fed. It's not all it's cracked up to be, but it is the rules that we're dealing with. So the Fed has a dual mandate of low inflation, low unemployment, or inflation target about 2%. Are they going to get that? I don't know. Is it real? I don't know. But we know they're going to try to have inflation. That's a fact. So because of that, and because the history of the last 150 years or so, inflation is more likely than deflation. I don't know if that'll continue to be. I'm telling you, man, you just look at the Japan model and you say, why would we be that exempt from what they have done? And people say, because our immigration. I don't know. I don't know. I don't know. I think it's debt. I think debt is the reason why Japan had its recession. I'm convinced of that. And I think we're the same, actually. And I think when people in the United States recognize the debt, especially if they see the model of the Japan where the debt in a deflationary economy just skunked them so bad, and they're saying, let me just get out of this debt to protect against a deflation. So I think first thing you do is you got to pay down any consumer debt that you got. Any consumer debt. And I'd say that in an inflationary concept too, because cash flow is king, and debt does rob you of cash flow. That's no other way around that. I get rid of all debt anywhere you can. Get rid of consumer debt without question. Number two, I would look at a cycle that says, look, if we go into a low inflation or deflationary economy, I need to have some cash on the side. I would absolutely, that's what I'm going to do. I'm going to build up some cash reserves for sure. Still have stocks, but build up cash. Absolutely. Cash is king, forever will be. You need to have cash. Inflationary economy or not, you need to have cash on the side. So you pay down debt, you build up your cash reserves, and then you let the stock market do what it's going to do, which has nothing to do with you anyway. So you got your total stock index fund, you got your total international index fund, combination thereof, and just hope for the best. Watch your fees. The one thing you can do immediately is eliminate and fire all your investment managers who charge you, more than 50 basis points. I'm just throwing that out there. Ideally, you shouldn't be paying any investment management fees. But there are people who offer value. My man Dustin down at Jazz Wealth, he offers value for sure. Is it worth it? It is for some people, and it's okay. Should you pay some guy who calls you once a year from Fidelity or Schwab or Vanguard, or actually Vanguard's it's not correct because they don't charge that kind of money, or from some other firm? No, absolutely not. In fact, a guy was telling me the other day that he was leaving Fisher, and the guy at Fisher Investments was like screaming bloody murder at him. He was going to Vanguard. I said, yeah, that's not kosher there, big guy. The guy is screaming at you because you want to protect your money. Whose money is more important? That guy was losing a big account, and he didn't want to lose that big account, so he's going to scream at the guy who was paying the big bucks. I found that to be, I just found that to be whacked. All right, so that's what you do in a deflationary economy. Remember, inflation, stocks, real estate, bonds, in that order. 1, 2, and no 3, if that makes sense. Much rather you don't have bonds. Still need cash. Cash, always got to have some cash on the side. Deflationary economy, cash, real estate, stocks. All right, hope that helps. We'll see you.